amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. This week, we continue our series Beyond Returns and look at multi-year advice and measuring it. That is the value of advice. It's difficult to measure. How did you get where you are? How many years did it take? How much long-term investment did you need? What were the returns? What was the risk? How much did you pay in fees? And what did you get? Was it valuable? So welcome back. I'm really looking forward to this session. What I'd like to do is to just encourage you to visit us online at astewardsview.com or on your favorite podcast platform. That's Apple, Spotify, and Amazon right now. Before we get going into this week's content, let's take a brief look at what happened last week. U.S. equities recovered from last week's drop with modest gains despite further weakness in labor markets. The S&P 500 and Russell 2000 rallied 2%, while the NASDAQ Composite advanced 3.5%. 8 of 11 S&P 500 sectors ended the week positive, but only 3 rose sufficiently to overcome the troubles from the prior week. Consumer discretionary and staples were the top 2 sectors, gaining 3% each, with technology close behind. Once again, healthcare was the worst performing sector, nearing 3-year lows. With the job market in focus from last week's employment report, weekly jobless claims hit 226,000, bringing continuing claims up to 1.974 million. That's the highest mark since 2021. Services sector activity stagnated, with the ISM Services PMI slipping to 50.1, barely holding on to expansion above 50. And Q2 productivity rebounded to 2.4%, following a 1.8% decline in the first quarter. Consumer credit rose by $7.37 billion in June, and household debt reached a record $18.39 trillion. Government debt wasn't very appealing either, with weak 10 and 30-year bond auctions. The Swiss president was in Washington for an ultimately unsuccessful attempt to negotiate a trade deal. That failure to come to an agreement may have influenced President Trump's decision to add gold to the tariffs that took effect this week. Combined, those brought our blended rate to the highest level since 1934. And gold reached an all-time high above $3,500 per ounce on the news. Stephen Moran, a noted Bitcoin advocate, was appointed to fill the vacant seat at the Fed, and President Trump signed an executive order allowing private investments in crypto and 401k plans. Bitcoin gained 2.5%, but Ethereum was the winner, gaining over 15%, hinting there may be an alt season after all. Earnings were mixed, with PLNTR, that's Palantir, McDonald's, and Uber rising, while AMD, Disney, Snap, and SMCI tumbled after their reports. Apple rallied after stating intentions to add $100 billion in domestic, that's U.S. investment, on top of the $500 billion the company had already pledged. This move caused the administration to grant them an exception from tariffs on Indian-made iPhones. India was in the president's crosshairs after their continued purchases of Russian oil, but OPEC announced production hikes that brought prices back down from the spike the week before. Over in Europe, investor sentiment collapsed as the Sensex index fell to minus 3.7, while industrial production in Germany dropped 1.9% in June. That's the lowest since May of 2020. Producer prices rose 0.8% month over month, and retail sales climbed 0.3%. The Bank of England had a split vote, but still cut 25 basis points, bringing their rate to 4%. China's services PMI expanded at the fastest pace in 14 months, while Canada's PMI rose to its highest point in a year. And some fun facts. This is according to FactSet, and I've already added this to our white paper or our blog post for the week. If you take a look on stewardsview.com, you'll find this reference in my comments for the week. But this is, again, according to FactSet. The forward PE ratio as of August 8th was 22.1, above the 10-year average of 18.5. This is data I didn't give last week. The forward 12-month PE ratio for the S&P 500 is 22.1. The PE ratio is above the 5-year average of 19.9, or this PE ratio, this forward PE ratio is above the 5-year average of 19.9 and the 10-year average of 18.5. It's also equal to the forward 12-month PE ratio of 22.1 recorded at the end of the second quarter. That's June 30th. Since then, the price of the index itself has increased by 2.2%. Meanwhile, the trailing 12-month PE ratio is 27.7. So that's some fresh kind of fill-in-the-blank information from the previous week. I mentioned to you that we'd be getting more kind of updated on PEs and forward PEs as time goes on. And remember that the price that an investor pays for an equity holding or an index and $1 of earnings in that holding or index, that's what PE is. Forward PE is kind of a guidance on what we expect investors to pay. Trailing PE is what up to current day is what they're paying or have paid. Okay. So thank you very much to FactSet for that good information. They also added a few key metrics I thought were helpful as of August 8th to our conversation this week. They had an earnings scorecard, and this is just fresh off the press. Here we are on Monday recording this August 11th. This would have come out on Friday. For quarter two, with 90% of S&P 500 companies reporting actual results, 81.0, so 81% of S&P 500 companies have reported a positive EPS, earnings per share, surprise, and 81% of S&P 500 companies have reported a positive revenue surprise. Earnings growth for quarter two, 2025, that's the blended year-over-year earnings growth rate for the S&P 500. That's 11.8%. If 11.8% is the actual growth rate for the quarter, it will mark the third consecutive quarter of double-digit earnings growth for the index. Earnings guidance for quarter three, 2025, 38 S&P 500 companies have issued negative earnings per share guidance, and 40 have issued positive EPS guidance. So let's talk a little bit more this week about how we measure advice. In past weeks, we've gone into a number of topics, and I've said, we're driving towards this very simple thing that I believe is going to help an entire community of investors, professionals, investors themselves, measure how valuable their allocation really is. Okay, and specifically, I'm talking about, now I call it the value of advice, and this is relating specifically to investment advice, not planning advice. Okay, so this isn't to say, you saved on your taxes, or you lowered your insurance premiums, or you improved your estate somehow. That's not the conversation we're having. So right now we're squarely in investment, and we're measuring investment advice. Okay, so in this week's iteration of Beyond Returns, I want to give us a universal method for measuring aggregate, that's overall portfolio risk and reward, in a simple formula. This is based on the capital asset pricing model. We've talked about William Sharpe, who he is, the CAPM, okay, CAPM, for those of you that are familiar. I've talked about that in this program as well. So I encourage you to look back at previous episodes where we've talked about total return investing, consistency investing, asset aggregation, even tax treatment of total returns and different return types. And we've even addressed fees as well. Okay, so what are the fees that I pay, and how important is that really, right? So all of this brought together, I'll reference, this is right from my master's work when I finished the master's in finance and economics that I hold, and that's just a thesis that I wrote that really became part of the Life Cycle of Wealth book that's coming back out this year. That there's one chapter in there that, frankly, I hesitated to put in because it's fairly complex, but it's posted now in this session's our website. You can go to the blog post and pick up Optimize Your Assets. Okay. And that's the name of that chapter from the 2018 edition of the Life Cycle of Wealth book. All right. So that there's a formula there. And I also posted the formula, by the way, from my firm's website. And that's essential to move this conversation forward as an investing community. Again, take a look at the post on stewardsview.com, the chapter I referenced in the formula that's there. When we come back, I'm going to go right into what that formula does and why I think it's important. We'll take a break and do just that.
Rural Music Fest is back, and this year features Seth Schluter, August 22nd through the 24th at Redemption Hill in Isle, Minnesota. Sing along with Sanctus Real. It's the 4th annual Rural Music Fest with bounce houses for the kids, food trucks, raffles and prizes, and music from over 15 Christian artists like Grammy Award winner Dante Bowe. And closing this year's Rural Music Fest, Colton Dixon. It's the Rural Music Fest, August 22nd through the 24th. Learn about camping, volunteering, see the entire lineup, and RSVP for this free event at ruralmusic.org.
And we're back. So in the first segment, I basically made the case and tied together previous weeks. And I said it's important for us to have a way to measure, and I'm trying to be clear, to measure the overall portfolio risk and return multiple years, right? So the longer term or long-term investment portfolio, right? When you consider, and if you look back to asset aggregation on this program, what it means to have an overall portfolio, we're talking about multiple accounts. We're talking about doing all of the tactical things you can to optimize a portfolio in terms of return types and taxes. And then at the end of the day, what we want to get and what's required, and we're going right to this formula that I'm proposing that, I am very optimistic will be received by the right people just from this podcast. What I'd encourage you to do is to take and get at least a 3-year or a 5-year. You'll need a risk score and a return score on the entire portfolio. So look at that. Get a Sharpe ratio even as a reference point. And we've talked about the Sharpe ratio. What is that? That's total risk, market and business risk, or standard deviation as a function of return, right? In other words, return, excess return for risk taken would be a way to describe the Sharpe ratio. Okay. But if we back up a bit and we talk about what the capital asset pricing model is and the formula that I presented in this week's blog post or white paper on stewardsview.com that's used by my firm every day, that formula is for mean variance optimization. Now, is it predictive? No, it's not. Nothing is in investing. Is it therefore anecdotal, like after the fact? Yes, that's exactly what it is. We're looking at historical numbers, 3 and 5 years back. Okay. So if you take that formula, what you'll find out is that we're using this CAPM system, this way of measuring the risk and return of an entire portfolio. And we're using, right from CAPM, this idea of the efficiency frontier, this concept of the capital market line that connects the risk-free rate, the 90-day treasury yield, with the edge of that efficiency frontier. Okay, and that's the capital market line. And there's a formula for that. That's a well-known one for portfolio theorists, academics, practitioners, all the above. What I'm telling you here is that if you the investor, and I want to talk to the investor right now, if you have pulled together all the pieces of your portfolio in a way that is measurable, where you have the risk and return data that you need backwards, multiple years, you can use the formula that I laid out at stewardsview.com and in the chapter Optimize Your Assets in the Life Cycle book. And you can take the return of the portfolio over any time period, but at least 3 years. I'm suggesting you could do 1, but 3 plus, for the sake of getting a real valid measurement. And you can subtract the capital market line from that return number. When you do that, all you're doing is you're looking for a premium. You're looking for a risk-reward combined premium. And you could think of it as an allocation premium. There's a concept in finance called covariance, or investment called correlation, that will measure the extent to which securities move together. Okay, we've talked a little bit about cylinders in an engine. It's along those lines. And so when you use this formula, what you're going to get is some sense of how all the pieces of the portfolio, all the accounts, all the holdings, whatever they are serving a whole number that may or may not be better than the capital market line. And by the way, for you practitioners out there, the capital market line, when you use an index, you bring an index in that's relevant, and you know what I mean. You take and you assign the capital market line a value of 0 for that index. Okay, so anything above that, any positive number above that is a value add or an improved risk, improved return, maybe both. Anything below that is a negative risk or negative return, maybe both. I'll leave it there as far as the technicalities of this, and just refer back to that post I just did with the formula itself and the kind of the laid out arguments for this method in my book. But I want to be clear, this is a way that you can look multiple years at once and say, how did I really do relative to the index on the overall portfolio that I have vis-a-vis the allocation? And is it optimal? If it is optimal, I'm going to have a positive number. How optimal is it is the conversation I like to have. So let's be thinking as a community about this. I'd like to hear your thoughts once you take a look at this online. Feel free to schedule time in the footer of that website. Feel free to go onto the platforms that we're on. Let's see, it's Amazon, Apple, and Spotify. You can, I think there's a contact there. You can email us even at team@astewardsview.com. That's team@astewardsview.com. That's another option. Send us an email, visit with us online, talk to us. What do you think about this? So what I'm proposing again is a method of measuring how optimal your mix of assets has been, even if you have transactional data. Okay. And we want to do that over multiple years. Why? Because if you're paying a fee, and I mean, somehow you're paying for what you're doing, but let's agree that you're paying some fee. You are comparing against an index. You're interested in risk and return, not just return, and you're willing to aggregate. You're willing to pull all this together, all your accounts into one place. And we do this every day at my firm. You go to fideiradvice.com/fusion. We'll help you if you want help. You're looking at the whole. Why? Because you're funding goals as efficiently as possible, and you want to know that the whole is greater than the sum of its parts, that the risk you took and the return you took are at least in line with what was offered in the relevant marketplace or marketplaces. In the case of a global portfolio, it's marketplaces. And then you're saying, okay, well, how much more value did I get? How much more optimal is this really? Or isn't it? I want to encourage you this way. I want to tell you that it is incredibly valuable for you to go and spend time at this. And this requires gathering your logins, maybe your statements, maybe both. Sitting down on, maybe the weekend, maybe an evening, and pulling together all of the data points that are needed to do this analysis. Why? Because if you're not optimized, or in fact you're suboptimal, particularly if you're paying somebody to help you, then you're going to know. Okay. And here's another thought. If you have a better way of measuring value added for advice or for allocation work, at least, please tell me. Use those contact points I mentioned. Let's talk about it. So that's what I want to leave you with today. I hope this is valuable. I hope it's clear. This is not an easy, easily digestible conversation, I realize, when you're listening. But before we wrap, let's zoom out and take a look at what's coming up this week. Inflation will be the focus this week, along with the revolving door of potential trade deals, with several reports anticipated throughout the week. Here at home in the U.S., expectations from the Cleveland Fed on inflation arrive Monday, and the U.S. preliminary expectations come Friday, with CPI, PPI, and import price reports sprinkled between. Germany will release CPI as well. GDP figures and confidence surveys will make up a large portion of the data this week. Month-over-month GDP from the UK, quarter-over-quarter, flash GDP from the EU, and preliminary GDP from Japan will all get released this Thursday. The NFIB Small Business Index, Empire Manufacturing Index, and preliminary consumer sentiment, all from the U.S., come out with similar reports from abroad. German ZEW economic sentiment and Australia's NAB Biz Confidence surveys will indicate the mood of investors there. Australia has a lot going on this week, with a rate statement from the RBA, a wage price index report, as well as employment figures. Industrial production and retail sales numbers from both the U.S. Thursday and China Friday round out the week. Unemployment claims may be more in focus than normal, considering this less than ideal number from both this week and last. And finally, investors are looking for additional evidence indicating a September rate cut, though that FOMC meeting feels like an eternity away after recent data. With that, it's been such a pleasure to be back with you. I do hope this session has been a benefit to you and others you decide to share it with. We invite you to connect with us online at astewardsview.com. That's astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.